live also. Hello and welcome. Thank you for joining us. Today we are talking about using life insurance for college funding. Did you know you could do that? I know a lot of people have heard about the traditional, 529 plans, college savings plans, but there are some very specific, six reasons that we're going to talk about today of why you would want to consider using life insurance for college funding. We're going to talk about how you could do it, why it's important, and let's get on into it.
Yeah, so look, it's all our mission is to help you understand different tools that's available to you so that you can play your financial game the right way. Think of it like a game of chess. You got different pieces on the board. There's different things you could do. So this is just one of the tools that you can use. The more you understand how the different tools work, the better you can use them to win the game. So once you hit them with the first one, the 6 things we're going to cover, 6 ways life insurance can help you with college funding. So
yeah, and as you come in, please let us know where you're tuning in from. Like, comment, and share. Ask your questions and tag anyone you know that could benefit from this information. So the first way that using life insurance to fund college, the first way that it can help you and why you would want to consider it is cash inside permanent life insurance is not defined as an asset for federal financial aid calculations. So it's a little bit wordy. We're going to give you the reasons, and then we're going to kind of like break down what that actually means. Okay. So in this case, so we're talking about permanent life insurance, not term policy, and that you can build cash. So the cash inside the permanent life insurance, it is not defined as an asset. So when you go and apply or
for financial aid calculation, it is an asset in general, but for federal financial aid calculation.
As I was just going to say, when you or your child goes to apply for financial aid for college, they look at what are their assets, what is their income, what is your assets, what are your income, and they look at how much money do you have to put towards college. 529 plans, that does get included. Your retirement accounts does get included. Life insurance, the cash inside the life insurance policies does not get included.
Yeah. So very important is something called expected family contribution. What do they expect that your family will be able to contribute to you when you're going to college? And that's based on their income, based on their assets, all these different things. So if you have certain things where you have money, but it does not count as an asset towards that calculation, that means it's basically saying as if that money is not there. In a nutshell, you have it, but for their calculations, they don't factor that in.
Now you don't.
Yeah, so they don't factor that in, which means you could potentially get more financial aid, federal financial aid, than if you had it in a traditional college savings plan. We're not saying traditional college savings plan are not bad. We're just explaining to you how it works, which things are looked at and which things are not. So that's one of the first things to understand is how you can use vehicles that give you benefits in more than just one area.
All right, number 2, your cash in the policy grows tax deferred, and you can access the funds on a tax-free basis. Like the sound of tax-free.
Yeah. So
what does tax deferred mean? Let's define that.
So in order to understand how taxable, there's tax deferred, and there's tax free on the distribution.
Woohoo! I love tax free.
So there's different buckets. Different financial vehicles are taxed differently. So for example, your bank account, it doesn't make a lot of money these days, but when it used to make a decent amount of money, anytime you earn interest, the bank would tax you each year off of that. You receive a 1099 distribution saying you received this much in interest, and then you have to pay income tax on it. Yeah.
Question: since it is not keeping up with inflation, the amount that the bank credits you, do you get a tax refund on that?
No.
You should get a complaint.
Technically, because a lot of people aren't making money with it, they're not reporting that. But if you make $10 in your
I
savings
need a
account,
refund because this is negative of inflation that you're crediting me.
Yeah, exactly. So if you earn money in your bank account, you have to pay taxes on that money. Most people aren't aware of that because it's not a significant. For a lot of people, it's not a significant amount. But every year you have to pay taxes. Now, what that means is it reduces your gains. So some people like to defer taxes or use vehicles that defer taxes, like your 401k. When you put money to your 401k, you have not paid taxes on that money yet. But the money that's inside of the policy, you're not paying taxes on it every year. So it just grows. You don't have to pay taxes on it each year until you take the money out. When you take the money out, it now counts as a distribution, and then you have to pay taxes on it at that time. So inside of a life insurance policy, when the money's growing and compounding your policy, you don't have to pay taxes on it. And then the insurance industry has a feature that allows you to take withdrawals and take loans against your policy, which allows you to access the money tax-free. So I can have money growing inside of this policy, get access to it on a tax-free basis, and use that to pay for my kids' college education.
Martin Matthews, same here. You guys are doing financial reengineering to assist lots of paychecks and private businesses to strive hard, saving for future.
Absolutely. Thank you for that. So yeah, and that's one of the things we started using that phrase engineering. You can re-engineer stuff, because when you engineer something, you're creating a predictable outcome. That's what an engineer is trying to do, right? They're trying to go from A to B, creating an efficient way to do that, and with as much certainty as possible.
And we didn't even have to go to engineering school.
You go to financial engineering school where you put financial pieces together. So why don't you talk about the next one?
All right, number 3, you can use the cash for anything. Remember, like 529 plans, retirement plans, you can only use them for specific things. 529 plans, you can only use it for school. So you can use the cash for anything. So if your child doesn't go to college, you can use those funds to help them buy real estate or a business. Think about what you think of college these days, how beneficial it is or isn't compared to the cost of it. Sometimes people just want to go straight into business or invest in real estate. What if your child is one of those people, but you have a 529 plan? Sorry, forfeit your money or have taxes and penalties, or only use it for school and force your kid to go to school. So this gives you a lot more flexibility to be able to use it for whatever you want.
So we have a policy like this in place for purposes for our son. Now he's still deciding. He's in high school. He may go to college. He might not. Maybe he's going to decide that he wants to go into the workforce. Maybe he wants to go flip a property. He likes doing construction type things. So he may want to say, you know what, I graduated high school. Maybe I want to travel for a few months. And when I come back, maybe I want to take on a project where I buy a property and then I flip it. And so maybe he may not want to go to college. So if I have just a college savings plan for him and he decides he doesn't want to go to college, and I go and take that money out to give it to him to go buy real estate or partner with him on a real estate deal, well, I would have to pay taxes on all of that. So if I have it inside of this structure like this, if he does not go to college, we can just take that same money and leverage it to go buy real estate that he can flip. Maybe he wants to start a business and not do real estate. Maybe there's something else. He comes up with an idea, he and his buddies. I don't know. So why would I be planning? Why would I plan? This is just my personal opinion. I have nothing against college savings plan. It's just not the most efficient thing for me to do. Because why would I
don't personally like them.
Yeah, why would I plan for a 2-year-old to go to college and set up a college savings plan for my 2-year-old when I have no idea if this person is even going to want to go to college when they're 18 or 19? So why wouldn't I use a vehicle that's going to give me more options? That's how I think about it. I'm like, okay, why don't I use vehicles that's going to give me more options? If I put it in this type of vehicle, then if my kid doesn't want to go to college, I at least have the ability to then shift and use those money for something different. I don't freaking know what they're going to do at 18, 19 years old. So
I don't freaking know.
So that's something, and I'm not going to give him the money at 18. You understand? Just because the person turns 18 doesn't mean you're obligated to just hand over this money. But when you start doing it for college, it becomes a different scenario.
All right, number 4. This is another reason that I prefer this strategy over a traditional college savings plan. Is the policies that we use don't lose money if the market goes down. Typically, traditional college planning accounts like 529 plans are in the market. So the market goes up, the market goes down, and you're subject to risk. Okay, so the policies that we use, they're not even in the market. So the market goes up or down and you don't lose money in that account at all.
Yeah. So one thing to understand is that college savings plan, why ask yourself these questions? A lot of people don't understand. Somebody said facts, marathon runner said facts, great. Somebody asked to be on a live. Roderick, type us a question. If you got a comment or question, let us know what you want to say on the live. So look, when it comes down to these kinds of tools and how to use them, a lot of people did not know that their college savings plan for their kids were invested in mutual funds ran by Wall Street. So as a result, in 2008, when the stock market crashed, they lost money in the kids' college savings plan. They probably didn't understand that the college savings plan was not a guaranteed thing. You were investing in the market through that. So you had to not only watch your own retirement account and watch your investment account, you also had to watch your kids' college savings fund if it was in a 529 with mutual funds invested in there. So with this, with using a life insurance strategy, for us, you don't have to. A person doesn't have to look to see if the market's crashing or not. The policies don't lose money. Some of the policies have fixed interest rates, earns interest and dividends. Other ones earn interest in different ways. So you can utilize this as a vehicle to still generate money inside of your policy without putting those funds at risk, at market risk, which is one of your biggest enemies of your wealth is market losses and market manipulation.
All right, number 5, if you got seriously ill with things like cancer, stroke, heart attack, the policy can pay you a portion of the death benefit while you're living.
Yeah, so look, nobody plans to get sick.
Now the policy would have to be on the adult.
Yeah, policy would have to be on, in this case, policy would have to be on the adult, right? So nobody plans to get sick. Nobody plans to get cancer. Nobody factors cancer into their financial plans. Nobody factors in having a stroke in their financial plans. Who would freaking do that? But it's something that happens to a lot of people. I think it's 38% of people will develop cancer at some point in their lives, which is a crazy number. And the thing is, it's not just
take a look at the food and medicine that we're given.
Absolutely. So it's not just about if you have those conditions that your body is hurting, but your finances can start hurting. It's the number one cause of bankruptcies in America. It's medical expenses. Somebody got seriously sick, and they were not prepared for it financially. So if you're planning for retirement, planning for college, planning for all these things, and you get critically sick, and you only have a life insurance policy that pays when you die, you're not dead. Nobody wants to get cancer and die from it. Anybody who gets cancer, they want to beat the cancer, right? So you're fighting to beat the cancer, but you're still living, but your life insurance policy only pays when you die. So you get no money from it because you're still living. So we don't use life insurance policies that only pays when a person dies. Nowadays, there's policies that can pay you while you're still living. So why wouldn't I use one of those policies? And this is one of the things that we discuss with people a lot. We own an insurance agency. Financial services, investments, different things like that. And so we educate people on different types on the life insurance side. Educate them on different types of life insurance because you don't. And a lot of times people are like, oh, I Google this thing. I Google this other stuff. You could go to the exact same companies we use. Do you know that insurance companies, they will have several different term policies, several different whole life policies, several different index universal life policies. And if you don't know which one provides which benefit, and you're just like, what's the cheapest one? You might get sold one that only pays when you die.
And you don't even have access to all of the information that we do from the companies because there's like all this internal information only for professional use for licensed people. So it's not even available to the public. You have to make sure that you're working with somebody that is knowledgeable about all these different types of companies, policies, and how to design them.
Yeah. And probably I think the worst thing a person can do is call a 1-800 number for a company to try to sign up for a policy. Because first of all, you don't even know anything about the person who's on the 1-800 number side. With us, you see us, people can reach out to us to see that we have a business. They know something about us. Same thing with the person at the bank. You don't know anything about the person at the bank just because they work at the bank. 6 months from now, that person could no longer be there. And then you're like, the guy set it up for me at the bank and now he left the bank. I don't even know who he is or where he works now or whatever. So then how are you going to make sure your policy is properly serviced? How do you make sure that you get all these different things that you're looking for? So we recommend you find somebody, if you like us and you think we're competent individuals, which we are, then you're welcome to reach out to us for help on these subjects. We educate our clients, we're there for our clients, and most importantly, when you need resources the most, when you have a claim, you don't want some random 1-800 number person that you sign up with for a policy that you don't even know, because how are you going to get through your claims process? You're not even going to know what to do next. So with our clients in our agency, the clients have a claim, whether the person passed away or has living benefits, meaning the person's got cancer, stroke, heart attack, whatever. Make one phone call to us. They let us know, hey, this is what has occurred. I've developed cancer. I've just recently had a heart attack, or I suffered a stroke, or this person passed away. We then say, we offer our condolences and all these different things. We say, I'm sorry to hear about that. And then we get into action on helping them with their claim. If you just go to Google and you sign up for a policy because they told you could sign up in 2 minutes, what happens when you get into that position? What happens when you want to? How many people reach out to me and say, look, I got a whole life policy. I don't even know how to take a loan against it. And they're like, I'm like, who set it up for you? Like, oh, some guy. Well, why don't you call them? Because the person never showed them anything about it. So you understand who you choose to do your business with is extremely important. You don't just give your business to anybody because they just randomly say, I'm here. Go to somebody who you feel is competent and who you feel like, I've seen this person have educated me. They've taught me things I didn't know before. That's who I should do it with, because that's who will be there for me.
And who can offer more than one type of company and product. Yeah. If one person just works for one company, they can only offer that company's products. But that company may not be the best fit for your needs. So we work with many different companies, and we can identify what is the best company and the best product and the best design of that product based on each person's specific needs, because everybody has different financial situation, different financial goals, different needs.
And if you're just joining us, we'll talk about using life insurance for college funding. Chelsea has one more point to go over.
Yeah, number 6, if you pass away, a death benefit pays out tax-free that can help your child's college education, that can help pay for it. So in addition to the cash that you're building in the permanent life insurance policy, if you were to pass away, then there's also a death benefit. So a lump sum will also go to the beneficiary that you designate. And if you designate, then it can go to help pay for your child's college, whatever you want it to go for.
Yeah. And then here's some tips. Do not make a minor beneficiary on your life insurance policy. Parents, they're very like to go, I want the money to go to my kid. How old is your kid? 4 years old. All right. Think through the scenario. You got $1 million life insurance policy. You pass away. Do you think any company is going to give $1 million to a 4-year-old? No, because the 4-year-old can't even open a bank account.
The 4-year-old would have to go get a death benefit, submit it to the life insurance company, and have a check sent to them to deposit in their bank account,
which they don't have. Don't make your minor children beneficiaries in your policy. You either make an adult in which you trust, like a parent, it could be a sibling, all of that.
Family member.
Until you set up a trust. And then you can make your trust, you can update your beneficiaries to be, the beneficiary will be the trust, right? So you can have a trust set up and funds will go into the trust for their benefit. So that's how you can utilize the trust. You can fund your trust with life insurance. At the very least, you should have at least a term policy, because not everybody can afford a permanent life insurance policy. We recommend that if you are trying to use this strategy, whether it is for retirement, using it to become your own bank, using it to help to pay for your kids' college education, whatever you use it for, we recommend that you are financially in a position to put at a minimum $500 a month, at a minimum, okay? If you're not already saving that or you're not already doing that, we have different resources and things that will help you get to that position. But if you have $100 a month, buy a term policy, save some money into reserves, right? And build up your income. Buy a term policy with living benefits, because the living benefits can pay while you're still living if you got sick or hurt. You don't have to rush to buy a permanent life insurance policy if you're not financially able to sustain it. I highly, highly, highly recommend against that. Okay. Get your cash flow up first. Show that you can maintain it. And somebody tells you, yeah, I'll sign you up for a whole life policy for $100. You're going to build cash. You're not going to build much cash. They're lying to you. The policy's not going to be designed right, whatever it is. I'm just telling you the truth about this. So anyway, I don't want to go off on a tangent here, but understand this is where you need to be, in my opinion, to start looking at a strategy like this. If you're not there yet, it's fine. We'll give you some tools and resources that will be helpful to you. So the first thing.
And really quick, the term policies that we help people put in place, they have living benefits, and they also can be converted into a permanent policy. So as you're working on increasing your cash flow, you've got coverage, you got the foundation, you have your financial survival insured, and you have the living benefits if something happens. And then once you get your cash flow up and you're in a position to do at least $500 per month, then you can convert it into a permanent policy, and we can help you to do that also.
Yeah. And so some people might think, oh, term policies are a waste of money. Look, I own term policies. One of my term policies will pay me $1 million if I got cancer, up to $1 million if I got cancer. Do you think I look at that as a waste of money? No. Do you think I want to use my own $1 million if I got cancer? No. I want to use their $1 million if I got cancer. So I pay to transfer the risk to them at the lowest possible cost, which is on a term policy. So that how you got to start thinking about it that way, because I'm managing risks in my life. I mean, anything that's a threat or a risk to me and my family, financially, in all other ways, I want to shift that risk to a company to handle that risk on my behalf, not for me to pay if I became in that condition. So that's how you ought to think about a term policy. Now, if you're financially in a position to utilize a permanent life insurance policy, why don't you tell them where they can go to?
Yeah, we can put together an example to show you what your numbers would look like using a strategy like this. If you are in a position to put at least $500 a month or $6,000 a year, you can go to sixbuildingblocks.com/bank, sixbuildingblocks.com/bank. We'll put together a customized example so you can see what your numbers would look like using this strategy. And if you're not quite ready, if you're not quite there yet, then we actually have a membership program with a whole financial platform. We have a Unbreakable Finances University, UFU for short. And
you won't forget that name.
UFU. And you can go there, you can increase your knowledge about what makes up your financial house, how you can strengthen each area, really to go there and get the information that you need to increase your finances, increase your financial stability, and to get to the place where you can take advantage of this type of strategy. So if you want to check that out, we actually have a special right now as a celebration for Martin Matthews hitting 20,000 followers on Instagram. Thank you to all of Mr. Matthews' followers.
Thank
you.
And
so our membership program is usually $49 a month, and we're doing it now for $20 a month. And there is a wealth of information in there. We're always adding to it. If you want to check that out, you can go to sixbuildingblocks.com/member, sixbuildingblocks.com/member. And if you have any other specific questions, you can feel free to reach out, comment, send us a letter.
Yeah. So Marathon Runner says, congrats. Thank you. Roderick's asked for the website again, sixbuildingblocks.com/bank. It's the numerical 6. I'll type that in the comments there.
There should be a link in our bio. Also.
Links in our bio on there. And by the way, inside of the membership deal, there's courses on how to become your own bank. There's how to use life insurance to buy real estate. We're going to upload that today.
How to handle inflation.
How to handle inflation. the areas of your finances: cash flow, debt management, reserves, property protection, build wealth, build legacy.
How to get it up and keep it up in your cash flow.
How to get it up and keep it up with your cash flow.
Handling
all of that.
debt.
All of that is there. Those are some of the things that when I first came to America, I wanted to learn. So I would put that together, and it covers a lot of different stuff. I think right now there's like 12 different courses in there.
There's a kids money system to teach your kids good money habits.
Yeah, so
Building
that's something
wealth,
you guys can access.
Building legacy.
And Marathon Runner says OPM at its finest, talking about the life insurance. Let me explain that for a second, how magnificent that is. So if I get cancer and I file a claim on my life insurance policy while I'm still living, I can receive up to $1 million. That $1 million is not taxable to me. It's tax free. If I had $1 million, right, just sitting aside that I'm going to use for this, let's say I receive $1 million, I receive more than $1 million, I'll have to pay taxes on it to net the million. So that means I would have to receive like 1.4 million. I would have to go earn 1.4 million, pay taxes on it, then net the 1 million to use on paying for whatever things I got to pay for relating to having cancer or whatever. Now, or I could just go and pay for it monthly, a very tiny amount monthly compared to the amount of benefit I could get, which hedges my risk. And I receive $1 million tax free, and I can do whatever I want to do with that money. That money does not go to pay a hospital. Your health insurance pays the hospital. The life insurance policy pays me. So I can use that money for whatever reason I want to use that money for, and I can do whatever I want with it. And just upon diagnosis of any of those critical illness condition. So understand, wealthy people do not use their own money. They use leverage. Wealthy people use leverage all the time. And some people think, rich people don't buy life insurance. Rich people have a ton of life insurance. They buy the most amount of life insurance. And they put the most amount of money inside of life insurance policies. So we routinely have clients who put 6 figures a year inside of life insurance policies. These are not your average income earners. These are high income earners. So I say that to understand that thinking about these strategies and tools differently. A lot of rich people use life insurance to save for their kids' college. And then they're rich, but the kids also still get financial aid. Why? Because like we said here, the life insurance policy does not count as an asset for financial aid calculation, whereas a 529 plan would. So all that. So somebody asks, you still have to pay back. It depends. It's a good idea to pay off the loan back, especially if you want to keep taking multiple loans against the policy. However, if you didn't pay the loan back and you died, we design our policies so that either the cash value policy will end up paying off the loan anyway, because you're just sticking a loan against your cash you already have in your policy, or the death benefit will end up paying off the loan for you, and then the rest of the money will go to your beneficiaries. So the loan gets paid back, whether I pay it back while I'm living or the death benefit pays it back upon my death, it will get paid back at some point. The insurance company allows me flexibility in my payback, which means I can control how and when I pay the loan back, because I have cash in my policy that's securing the loan, and I have a death benefit in case I die. So that's the structure around it and how we use it. All right.
So if you want to see an example of your numbers using this strategy, and you qualify by being able to put at least $500 a month into it, you can go to 6buildingblocks.com/bank. If you want to check out our membership program, you can go to 6buildingblocks.com/member.
All of these are linked in bio and Instagram. Sorry.
Thanks for tuning in.
See you guys next time.
Oh, have a great weekend. And also, we will not be here on Monday.
We'll not be here on Monday.
So we'll be back on Tuesday.
Yes. We're closing the office